Hello everyone, it's been quite a while since I gave a full portfolio update and quite a few things have changed. So we'll be jumping into it today. If you're new to the channel, I invest in high quality companies with fast growing free cash flows. These companies tend to be monopolistic or have a history of a distinct advantage over their peers. I hold just 9 positions in my portfolio, so it's highly concentrated. I've added a lot to these positions lately, so I'll be going through my overall return, my individual holdings, and finally my hopes and dreams for this portfolio as a whole. So lots to get into, and if you get something out of it, then please feel free to like the video and maybe subscribe to the channel so you don't miss out on anything. So first off, let's go through the main portfolio I have, which is an overall return just over 4% in the green, up by £1,300 or so. Now before that makes a lot of you switch off from this channel, please bear in mind that I've only started investing since May 2023. And since then I've converted an entire portfolio from my taxable account over to my stocks and shares ISA. Additionally to that, and more recently, I've transferred over £14,000 from a cash ISA that I held with Santander over to my Trading 212 stocks and shares ISA. So this is an amalgamation of all of those things. So whilst that return may seem small, I've added a lot to these positions over the past month, and it doesn't really show my full returns that I had in a previous portfolio. But that being said, we have a total value for the portfolio sitting at £34,535, with £3,134 held in cash, which is roughly around 9 to 10% held in cash. Now this is more of a buffer than anything else. I originally said I wanted to have a bigger cash position in a previous video. However, I put that money into stocks I have high convictions with that I believed were undervalued, and still do. So time will tell if this is the right process, but this is the way I've decided to move forward. However, I still want a cash position of some sort, and this fits the bill. Any of my positions go down on particular dips, then hopefully I can use this cash and the cash that I keep adding every month to fill those stocks out. Kicking it off with my biggest gainer, and that just seems to be jumping from strength to strength, we have Texas Roadhouse. Now I was buying Texas Roadhouse when it was below $100 per share, and now it's trading above $160 to $170. Now the reason I was buying it was because I believed it was undervalued at the time, from DCF models and a few other things. So I recruited this one quite heavily with how much I was putting into the portfolio at the time. And it just shows no sign of a correction now. I have 18 shares at a cost basis of $118, up over 40%, so £700 in the green. For those that are not aware, Texas Roadhouse manages and operates 753 restaurants worldwide, but mainly operate out of the United States. Now they're mainly a sit-down style restaurant that has grown rapidly in the last couple of years, offering a 23% CAGR in revenue top line growth over the past 3 years. Now that's growth when a lot of people didn't really think that they would have or offer that level of growth at the time when I was investing. What I love about this one is its potential for growth. When I was buying them, they were sitting at a market cap of about $8 billion. And now they sit just over 11 billion. So a lot can change in a small amount of time of little over a year. Now their relative small size just means that a lot of big investors, so super investors and ones that are operating with billions or millions, just can't invest in it going forward. And if they see this kind of growth, I can think that will change over time when this one gets bigger. Texas Roadhouse is doing great things for shareholders as well. They have a starting yield that was above 2% when I bought them, and more importantly they are growing this in the double-digit percentiles per year, raising it 11% in February 2024. Additionally, they have begun to buy back those shares, reducing them from 69 million in 2022 to 66 million in 2024. Now its weighting as part of the invested stocks I have in my portfolio is just under 8%, and I'm fine with that for this stage. Next on the list of highest returns is Microsoft, my smallest position at 2 massive shares with a share price sitting at $326, valued at over £700, with over 38% of that from returns in the green by nearly £200. Now personally, I love this company. Their subscription-based model, their monopolistic positioning over integral systems that are used every day by businesses like Office applications and Microsoft Teams. So that's not even mentioning their AI capability. Now their financials are growing rapidly for such a big company, more so than Apple with its size. So they have a 14% CAGR in top line revenue and a 13% growth in free cash flow CAGR over the past 5 years. And that's all without mentioning what they're doing for shareholders going forward, which is the likes of growing their dividend in double digits, raising it 10% this year, and buying back shares consistently about 1% per year in the past. And I believe this one is maybe one of my biggest mistakes or omissions when I got into investing. I knew the value of this company and I still didn't invest as much as maybe I should have done. And I hope it will return to buying levels in the future to increase its weighting past what it currently sits at, which is just over 2%. And then we've got my United Health Group holding, which is 7 shares at a cost basis around $451 each. This position is valued over £2,700 and is in the green by over 6%, just over £150 in unrealised gains. This is an excellent high quality company that is the biggest healthcare provider and insurer in America. And that just means they've got high barriers of entry in their industry. That's from competitors and has boasted a dominant market position since the last decade. However, despite this one's double-digit dividend growth and fast-growing operating cash flow with 13% CAGR over the past 5 years to $29.1 billion, I've just got concerns of my knowledge in this particular sector and my understanding of this company's revenue streams and how it produces money. It's a complicated business that I thought I understood. However, I don't have the first-hand knowledge like I do with some of my other stocks. So I'll continue to hold this one, but I'm going to keep an eye on it. And if the fundamentals change, I may get out of this position. Its weighting in portfolio as invested stock sits at around over 8%. And next we've got my largest holding, and that is fairly new, one that I've been adding quite heavily to this month in particular, and that's Amazon, which needs obviously no introduction. And I currently have 46 shares at a share price around $180. In the green in unrealised profit by 4.52%, so close to £300, and valued at over £6,800. Now, this is the most I've ever had in one particular stock, mainly due to the fact I believe it is undervalued right now. As I talked about before, the price to operating cash flow for this particular company sits historically lower than the median and average of the past 2 years. They're currently priced around 19 times to operating cash flow compared to the historical average of 25 and the median of 22. So this is my largest bet, mainly because of the massive margin expansion taking place with this company right now. They're finally becoming very profitable. So Amazon is just producing record amounts of free cash flow right now, and they've begun to advertise quite aggressively, which I like to see in their business model. So we'll see what happens to this one, but I am always quite confident and quite happy with Amazon going into earnings. It currently accounts for around 20% of my investments so far. Moving along, we have, of course, Visa, which I produced a video on, and if you didn't catch it, please feel free to. It was last week explaining how this company sort of makes money and my reasons for buying quite a bit more quite recently. So I currently have 20 shares at a share price of $264 per share, and it's valued over £4,300. I'm in the green by over 3%, so around £150, and that currently makes up around 14% of the invested part of this portfolio. Now, this is an excellent and predictable company that I've just got massive faith in. It's an effective duopoly, and their double-digit dividend growth is just very nice to top it all off. So I really do like this one. Next on the list, we've got S&P Global, which is my exposure to the ratings and analytics industries. I have 7 shares at a cost per share basis of around $419 per share, valued over £2,400, in the green by over 3%, £80 or so in unrealised gains. Now, SPGI operate an effective oligopoly with the likes of Moody's and Fitch, which isn't publicly traded. And I like the diversity and growth potential that S&P Global offers in their company portfolio. Their ratings and markets analytics offer the best lines of growth for this company, in my opinion. And in a similar vein to the other ones in my portfolio, they offer a double-digit dividend growth rate CAGR, albeit not in the past year, because of their acquisition of IHS Markets. But that acquisition will actually put them in great stead for growing in the future. Now, they only expect around 8% revenue growth in the future for this year, which isn't ideal, but its weighting is over 7% as part of the invested stocks. And I'd still happily build on this particular investment if it came below maybe $400. So I'll be keeping my eye on that one as well. Then we've got stocks that I'm flat or down on by share price, which there aren't too many. My relatively new position in MercadoLibre sits at around 2 shares at a share price of about $1,617 per share, valued over £2,500, and it's completely flat pretty much. MercadoLibre is my solely international stock, and that's because I believe they have amazing growth prospects similar to Amazon. They've got revenue growth that is its highest in my portfolio at a CAGR of 59% over the past 5 years. They do not pay a dividend, and they haven't yet to repurchase shares, with a lot of their free cash flow going towards reinvestment back into their network, spending over $3.5 billion in investments in 2023. Now, I have slight concerns about the Argentina economy impact on this particular stock. However, it seems to be handling their prospects in Argentina quite well, and it's not their main sources of revenue. It currently sits around 8% in the invested part of my portfolio. And then we've got my second to largest position, which is Salesforce. As I said before, this company, I believe, is undervalued, and have been adding to it heavily, jumping in from £2,000 all the way up to over £6,000. And I currently have 32 shares at a value over £6,200, and it's currently down by over 1%, so £82 or so. Funnily enough, this stock has recovered already very rapidly. Over the past week, up 5% for the last week or so, with the market up less than 1%. And I remember being down over 10% in this position, so I'm enjoying getting the share price lower and lower, and it now sits very close to that share price. So we've got a share price of around $248 per share, and its current share price of $245 per share. So I like the market dominance of CRM and the subscription-based model that they offer. I'd prefer them to stick and steer clear away from acquisitions and keep providing value to shareholders. Time will tell, but their new dividend of $1.60 per share, I expect to grow in the double digits going forward through this company. Their payout ratios will allow for that. And I'm still very impressed by their 3, 5 and 10 year CAGR in terms of growth of free cash flow, which sits at 28% over the past 5 years to $11.3 billion, which is great to see and really just one of the best in my portfolio. Now going forward, I would prefer the weighting for this one to be slightly less than it currently sits at. It's currently about 20%, close to it. And I just couldn't pass up the share price I'm currently seeing. Its yield on cost for its free cash flow is just far above what it's been in the past 2 years. So I couldn't avoid keep adding to this one at this stage because I don't think it's going to last forever. But I may trim this position once the stock market realises that and we see some overvaluation start to go into this stock. But obviously that's maybe for the future, if it will even happen. And then we've got my worst performer. And this one has stayed my worst performer almost since the start of me investing. It's the highest dividend payer as well. So in reality, we're actually almost flat in this position because I've had it over a year and the dividend amount is above the amount of the share price that I am down. But in any case, that is VICI Properties. And I currently have 138 shares at a share price of $29.80 per share. Now the position itself is valued over £3,000 and is down over 5%, so down by £180 in the red. Despite the current share price, I don't really mind being down in this position. I bought some more VICI the other day for over £500 and I'm still collecting the dividend, which is obviously close to 6%. As we know, obviously REITs have had a tough go of it this year and probably will going forward if those interest rates don't materialise. But if we do see those interest rates recover in any particular way, which we expect them to, I've got faith in this one's ability to use those triple net leases with their tenant lease agreements of over 30 years. And I think that they'll do very well and the share price will start to appreciate. Their AFO has been growing, they'll continue to collect rent, people will carry on going to Vegas. So I'm not really that worried. In terms of its allocation, it's close to 10% and it accounts for around the majority of my dividend income. For final thoughts, guys, the positions I have been adding to lately are the companies I think are undervalued, which is of course Amazon, Salesforce, and of course VICI. Similarly, I think MercadoLibre still offers quite a bit of undervaluation given its historical average for price to operating free cash flow, so that's why I opened a position of them more recently. In terms of fair valuations now is I think Visa, United Health Group and maybe to a lesser extent SPGI. They're not under or overvalued right now and I've been adding quite heavily to my Visa shares because I have such conviction in that particular stock. And then finally, I think Texas Roadhouse, Microsoft are just past their intrinsic value. I have no plans on selling them right now, but I've got no plans on adding to those positions unless they come down a bit. I would like to add to particularly Microsoft. Now my plan to continue to add to these positions is just to avoid opening new positions unless I see a particular stock that I just can't pass up. I hope to get around £50,000 in this particular portfolio by next year. So that's the target I'm working towards. And that will put us in great stead for getting to 100k in the coming years. But what do you guys think? Do you like this portfolio? Do you like my holdings? Is there any you'd change or maybe steer clear of? Then let me know down below and I'll be happy to have a nice chat with you guys and see what you guys think. As always, thank you very much for watching. I do appreciate it and I'll see you in the next one.